Are you making this mistake and it's costing you money? Hey, what's up, YouTube? It's Joe Catchpolia, sitting on the couch making some money investing in fractional real estate online, as usual. Today, I want to talk a little bit about the math behind my discounted token strategy. And I say that my strategy. I mean, I think it's what a lot of people are using on Lofty. We're buying, tokens that are a discount relative to the real world price and making some money, by doing that. I think it's the dominant strategy on Lofty at the moment. I think you can make more money doing that than anything else on the platform. Again, you want to do your own due diligence when you're doing this. It's, just because it's the way that I'm making money on here, it doesn't mean it's going to work for you. I see a lot of people making several mistakes, and I think some of them are just probably losing money outright, and some of them are making much less money than they think they are when they're employing this strategy. There's two main errors that people are making. I think the first one I'm going to cover just real quick. I think it's really obvious what that error is, and so I'm not going to dive into the math on it. But the second one, I actually we're going to do some math, get a little bit nerdy today because I think that it's lost on some people, and um, in a way that I don't know. I'm not really sure. I think people are just doing lazy guerrilla math, and I'm all for that. There's a lot of times that I'm just trying to use rules of thumb and just general getting a general idea, and I think it's good enough. But this is an instance where I think people are really screwing up. So the first mistake though, and this is the more simple one, right? So we have this property. I just picked a random property, but if I'm okay, a lot of people are saying, okay, it's $21. That's a $29 discount because the par value is $50 per token. Well, let's take a quick look at this, right? At $50 per token, I said we're not going to do math. We're doing easy math about this, right? So, and actually, the house canary is very close to $50 per token. So, that would mean our par value is 108,000, right? That's what people that are making this first mistake are doing. Well, okay, let's say we do some research, we dig into a bunch of different things, and then we decide, oh, the actual value is, let's say we decided the actual value is 89,200. I don't necessarily, this isn't even this estimate here. I think this is the last sale price. But let's say that we did the research and the real world value is only 89,200, right? That happens all the time, right? I mean, and so if we do the math there, 89,200 divided by the total outstanding tokens, 2176. Well, the real price of this is, the real value per token is only $41. Assuming that was the right number, right? I'm just trying to make a simple example here. And so you're really not getting a $29 discount. You're getting about a $20 discount per token. I think, when once you say that to somebody, it's a really easy to understand. It's not, um, that math was very simple. I think that you don't even have to do that. You can just explain the concept and it makes perfect sense. But I still see people talking about this always talking about $50 per token, not talking about the discount to the real world asset price. And that's the discount that matters, right? The discount from 50 is meaningless because that $50, some of these properties were brought on here and they were never worth $50. Some of them aren't worth it today because of the condition of the property, right? There's all different reasons that your real world value might not be equal to $50 per token. But for this second error, I'm going to just assume that it is worth $50 per token because I think this is the sneakier problem that a lot of people seem to be messing up when they're talking about this and when they're thinking about it. So let's say, okay, the par value is $50 per token and the real world asset price is actually $50 per token. And so for my example, we're using a $100,000 real world asset price and 2,000 tokens in total. And so, okay, if knowing all that, and I see that there's a $30 token out there, um, you know, it looks like a 40% discount, right? And so if we know the value of the property and we know the discount of the token, is that everything we need to know? Well, it's really not, right? And it, for whatever reason, some lots of people that seem like smart people to me, when they talk about these discounts on on different properties, seem to really be missing this point. And the point is that there's debt, right? And so the if you have the unlevered properties and you have that token discount, that's worth much more than if you have a levered property and you have that discount. And the reason is because the debt tokens are never discounted, right? The debt tokens are always represented as $50 per token. And so let me just get into this a little bit. So you have your real world asset price. So we're going through the no debt scenario first. You have your real world asset price, it's $100,000. I'm using 9% for closing costs. It's a relatively conservative assumption. If you have, let's say you pay 6% realtor fees, whatever you're paying in your market, but if that's what you pay, plus another 2 or 3% in other closing costs, 9% tends to be a pretty safe assumption, unless the real world asset price is very low, because certain costs are fixed costs, and so sometimes that'll make your closing costs a higher percent. But on a $100,000 property, 9%, $9,000, it's a relatively safe assumption. And so in this scenario, we have no debt. Normally, when I'm doing this, I also, you also have to account for unpaid bills that are going to get paid off. So you subtract that from your proceeds, but then you add in any operating reserve that you might be holding. I just put both of those numbers as the same for this example, just so it would be a wash, because we're kind of ignoring that, right? And so, okay, just the sale price, the real world price, $100,000, minus just your closing costs, $91,000 net proceeds. Really, we accounted for these other two things as well. And so in this scenario, there's 2,000 tokens outstanding. All of those tokens are equity tokens because there is no debt. And so we just divide the 91,000 by the 2,000, and our net proceeds are going to be $45.50 per token. Well, if we bought these at the $30, the discounted token at $30, and then we sold this in the real world and we net $45 per token, we get a 51% return. Uh, you know, this might be a little bit higher than we're seeing most of the time, because a lot of times we're not actually getting a $50 per token real world sale on a lot of the stuff that's sold so far. But I mean, on a recent one that I put out, I think I got a 45, right? So I mean, it's not beyond the realm of possibility whatsoever. And you can see, okay, this is fantastic, and these are the types of deals that I'm looking for. Before I forget, please like and subscribe. Uh, and also, in the description to this video, there's a link to a Discord that I've set up that's got a whole bunch of us investors that get in there and talk about fractional real estate investing every day. We talk a lot about Lofty, Mogul, Ground Floor, couple other platforms. There are links in the description to this video to all the platforms that I currently invest on. Again, do your own due diligence on all those platforms and any properties that you might buy. Just because I'm using a particular strategy or buying a certain property doesn't mean it's the right answer for you. Okay, back to what we're talking about here. Um, that was the no debt situation. But so let's say we take that same property and all we're doing is adding a mortgage, right? So real world asset price, 100,000. That's what we sold it for. We have our $9,000 in closing costs. In this scenario, we had a mortgage and we have to pay off that debt. Now, this is going to be more the co-ownership properties, right? Because a lot of the older ones don't have those. But we're starting to see some pretty decent discounts on some of those co-ownership properties. And so, um, I in that's where I noticed people starting to talk about it and really making the mistake of thinking they were getting some huge deal by getting this discount, and it's really your return from a discount on the ones with debt are nerfed quite a bit, and let me show you why. So okay, again, we're paying off $80,000 in debt. You have the unpaid bills and the OR. Again, I just had them be a wash. Our net sale price, or our net sale, we're only getting $11,000 back. Now, and this happens because debt tokens are always paid $50 per token, right? And so we had 1,600 debt tokens outstanding, right? It's because that was the actual debt was $80,000. So the good news is you have, only 400 tokens that get to split this $11,000. The bad news is that's only $27.50 per token. Sorry about that. I actually had to pause my video. I realized I had an error in my Excel here. I was using the $50, the loss from $50 versus the actual $30 purchase price here. But so, okay, we got $27.50 per token in this situation, which is significantly less per token because we had to pay off the debt. And so where we made 51% in the scenario with no debt, when we had the debt, we actually lost 8.33%, which is a ridiculously terrible result when you think about we're buying at a 40% discount from the original price, right? And in this scenario, they're selling the property at the original price, and we just have some closing costs, right? I mean, there's really nothing else. And so, if you think about it, if you're forced to turn around and sell any of those $50 token properties that you're paying $50 for, well, that's the next scenario we're going to look at. Okay, so okay, now let's say, well, we didn't get the discount, right? So obviously we're getting this, we get this big discount, we make a huge return if we didn't have the debt, and potentially we're losing money if we do have the debt, right? And it's going to depend, right? I mean, this is an 80% levered property. We you know the So the closing costs end up being a huge percent of the equity. But so, okay, now let's say we bought it at par, right? We bought this same property at $50 per token, and then whatever happened, we're forced sellers, we have to sell it. Now, one thing, if there's no debt, it's very unlikely we're forced sellers anyway, right? I mean, it's almost in a scenario where we own it free and clear, this isn't going to happen very often. Normally, when we're selling these ones, it's opportunistic, right? It's because the token price is very low relative to the real world price. All that does is imply that this property is worth more to an owner occupant than it is worth to an investor, right? And so we sell it in the real world, we get more for it than we're going to get for the tokens, or than the Lofty is going to price it at. But so in that scenario, you bought it at $50 per token. You sell it at the real world price that's equal to the $50 per token. Okay, we lost 9%. Well, that makes sense. That's just the closing cost that we have to overcome, right? Now, everything I'm doing today is ignoring the fees that you paid when you purchased it, right? Um, and so that gets even worse. But in this scenario, okay, I bought it at par. I bought it at $50 per token. I turn around and sell it at $50 per token. We haven't held it long enough to pay down any of the debt. And it's 80% leverage, and this is how it was. Uh, in this scenario, we're actually, you're still just getting the 27.50 per token, but it's a 45% loss, right? And which is, it's a huge loss considering you're selling the property for what you bought it for, right? I mean, and it's because the equity is so small, 20% equity. If you have 9% of closing costs, it eats up almost all your equity. Now, it gets even worse when you start to think about, okay, well, in scenarios where I'm a forced seller, it's probably not worth $50 per token anymore, and maybe it never was, right? And so, um, it makes it's a significantly worse deal. Now, I mean, anybody that's been investing in real estate for a long time, or even if you're a finance person in general, like this is not a surprise to anybody, that has really thought that through. Because leverage increases your return. Well, and that's what's funny here, right? Because most of the time people think about, well, leverage increases my return. Um, and I think here, but it also increases your loss, right? So if you have a loss, you're going to have a worse loss. But what's happening here, right? Like normally you think leverage increases your return, but it's not happening here. And it's because the discount that you're getting is not you're not getting the same benefits of leverage that you get in the real world with this discount, right? Because this isn't when there's no leverage, what's being discounted is every single token. When you do have leverage, that discount only applies to the equity tokens. It doesn't apply to the debt tokens because those are fixed at $50 per, $50 of debt is each debt token. And so this is, it's a little counterintuitive, or it seems to be to some people. Um, I don't know that this was immediately apparent to me, but because I'm always doing math about this stuff, it's something that I realized pretty early. And so, getting a 40% discount on a token uh, with no leverage is a true 40% discount. But getting a 40% discount on a token with leverage, um, is it's not, right? It's a 40% discount of, and if we have 80% leverage, you're getting 40% of 20%, right? And so you're only getting an 8% discount there. And then in this scenario where we're paying 9% in closing costs, we're actually end up losing money. And so you might think, well, okay, this is hurting us in the scenario where we're buying at a discount. But what about when the tokens are at a premium, right? Because you start to see, okay, sometimes the tokens are worth more than the real world asset value. Well, in that scenario, this doesn't really come into play, right? Like, so this hurts us when we're going to sell in the real world. Well, if our tokens are trading at a premium to the real world asset price, we're never going to sell and realize, pay off the debt and realize that. And so um, it ends up being, it doesn't have it's not a two-way street in the same way that leverage tends to be in a lot of scenarios. If you just own a property in real life, when you make more money, you do better with leverage, and when you make less money, you do worse. Well, on Lofty, that does work. The leverage does help us get higher yields, but it doesn't necessarily help us get higher overall return. On the appreciation side, we're not getting the benefit of leverage, because in the same way. I mean, you do get leverage, but it's only the same. It's always equal to your asset level appreciation. Um, because, well, I say it always is, because the co-owner has the ability to pay off that debt at $50 per token, and then if the property gets sold in the real world, um, they've converted all those debt tokens to equity tokens, right? Now, maybe you get to a sale with a property that has debt on it that they didn't actually do that, and then you do get some levered appreciation. That's possible. Um, I think that and, we might actually see that scenario play out with some of these co-ownership properties that are changing management right now. But I think it's an odd situation. It's not one you're going to run into very often. I think typically you're not getting any levered appreciation with, even though there's debt, um, because they have the ability to pay that off if they want to for $50. So, like, say you have $80 tokens, and the property is worth $80 per token. Um, then of course you're going to pay off your $50 tokens, convert those to debt or to equity before you'd want to sell. And I think, I think that scenario, although it's one that I'm concerned about, I think it's much less likely, right? Especially if you do have a property that's doing well like that and you're getting your yield. I think it's unlikely that that property is going to sell in the real world, right? Like, most of the time, the ones that are selling in the real world are ones that there is, um, it's not doing very well, right? And so it's almost, I probably just shouldn't have brought it up because I just made it a little bit more convoluted, right? I just wanted to point out that you don't really have the flip side. So usually leverage works both ways. And in here, um, it is really hurting us on the appreciation side, but we're not, where we benefit from it a lot on Lofty is on the yield side. And it's why you see these unbelievably high yields um, on some of the co-ownership properties that have debt. But and I guess the key is on those, yeah, your discounted token might be making your yield much higher, but trying to do the same sort of strategy where you're buying that discounted token to move to a real world sale um, is not nearly as effective as it is with ones that have no debt on it. Uh, that's really the whole point that I'm making with this. Um, that and that you have this much higher risk when you have the ones that you are buying with debt, because they are the ones that are more likely to become a forced seller. And in those scenarios where you are, it's really easy to wipe out like 50% of your equity or close to it, right? And so like there are a decent number of properties that have been brought to the platform in the last several months, that I've mentioned that the debt on them scares me. And this is exactly why, right? Like if you become a forced seller on those because because the original co-owner who brought it can't pay the debt, and the property itself can't take over the debt and make it work, so you have to sell. In that scenario, uh, if the price that you paid on the token, even if you can sell it at $50 a token, which a lot of those you probably can't because they were sold at 5% above the appraised value. But just as even assuming that you are, after all your closing costs, you're probably losing, close to half of the investment in those deals. Um, and so that's why I've avoided a whole bunch of the levered deals, even though they have sometimes really nice looking yields. Uh, the risk reward there compared to buying the discounted ones with no debt and moving them to a real world sale, like at the moment the comparative returns, even if I were making the same return, let's say, um, the downside risk of the no debt true discount property versus the par value or maybe above real world price value, levered return, even if we had the same expected upside, because of the risk of the downside, it's just a tremendous, it's such a better strategy. And now, when we start to see a situation where you're sort of in between these two, in spots where we have, you can see, okay, we have a real big negative number. This one's not real big, but some of them have like a big negative number that's basically unpaid bills, or you have a loan out to the Universal Lending DAO or something. So sometimes it's somewhere in between. The smaller that percentage of leverage is, the less impact it's going to have on the deal in general. So this is just one of, back to just the main point, right? Is that a $30, the discount that you're getting from $50 is it's not the same on every property, right? And so you can't just be looking at, there's definitely some people that say, oh, look at that token, it's $20, let me buy it. That's a cheap token. And without understanding what the real world value is first, and that's the first step, and then understanding what the debt situation and unpaid bills look like, you really can't tell if that's a discount. And the what your net proceeds are. And these discussions, they just happen daily in the Discord, and so it worries me that a lot of people are making that mistake. um, in both of those mistakes, right? One, thinking that every property is worth $50 per token, and then two, ignoring the effects that debt has on, you know whether or not you're actually realizing a benefit from getting that discount. I think that's really it. I think, hopefully those 2 points are clear. If you're somebody who has been buying discounted tokens, are both of these things that you're looking at? Have you been doing the full math of what you expect for a payout, or have you just been looking at, what your gross, discount is, and you making a judgment off of that? I'm super curious because, like I said, I mean, I've seen this discussed quite a bit, and people that are very smart people and that have, I have a good opinion of with a lot of other stuff that they said, are sort of missing this aspect of it to where, you could have a significant loss even if you're getting it at a discount. That's it. I think I've said that like 17 different ways. Hopefully that's helpful. Um, Tickle the like button if I haven't said that. I think that I might have. I don't know if you noticed, but This video was cut up several times because I just had a lot of technical issues, and then I also I think I made even showed you when I stopped and fixed this, but had some other issues with the recording. So hopefully this worked out okay. Nobody did tell me after the last one what they thought about me continuing to do shorts, or if you just think those are dumb. If you got to my channel from watching a short first, I'm really interested to hear that. But in general, I don't know. I just they don't feel as useful. But lots of people who keep telling me I should do them, so I figured I'd try a few and see how they go. But yeah, let me know what you think. If you watch this channel, are you also somebody who watches shorts a lot? I feel like I'm just not a shorts watcher. But you can tell like I don't do anything quickly, right? Like I talk for in full paragraphs and sometimes in full chapters. So maybe it's just the way my brain works, but I'm assuming that if you're looking for the type of info that we're talking about here, that you're not, at least most of the time, not the same person, or at least not in the same frame of mind as somebody who is just watching shorts and scrolling through those. But maybe I'm wrong. Super curious what people think about that. So feel free to put that in the comments, or jump in the Discord and tell me, or send me DMs. A lot of people, a lot of you guys are doing that, and I enjoy that as well. I mean, I feel like we're building a nice little community, so hopefully we keep that up. In any case, until next time, I'm going to keep making mistakes so that you don't have to.